All right, in this video, we're going to break down the estate tax. What is it? Why is it? And then in future videos, we'll talk about some different ways to maybe decrease your liability here. We're looking down the line. I just want you to be aware of this. This is not something that is imminently going to affect any of you, but I think probably most of you will find this very interesting. And given enough time, depending on your situation, given enough time, you can structure things optimally for this, okay? But we'll just make this pretty brief and hit the highlights. So what is the estate tax? It's also called the death tax. According to the IRS's website, the estate tax is a tax on your right to transfer property at your death. Now, a lot of people do not like this. Some people actually do like this, right? This is a way, if somebody has significant amounts of wealth, this is a way for the IRS to tax a lot of that so that they're not passing all of it on to their heirs. And it kind of keeps a cap on the generational wealth that can be created over time and over multiple generations. It kind of cuts down a lot of that, and the government takes their cut. So some people like that, others really don't, and say it's unfair. I'm not going to make an objective ruling here on whether or not that's the case. I'm just here to teach you about it. So that's the estate tax. Now, what they do is they take the total gross assets of your estate, add them all up, and that's how they determine. Now, they give an exemption. So essentially, you owe tax on the transfer of property upon death, but they grant an exemption. So they say, hey, if you pass on up to this amount of assets, we're not going to charge you tax on any of that. You're going to get an exemption. Just anything above the limit, then we'll start to tax it. Okay, and the limits are pretty high. In 2022, the exemption, the estate tax exemption limit is $12 million, $12,060,000. So if you pass on anything below that amount, it is all exempted from the tax. It's tax-free. Okay, that is a substantial amount of money. And every year, this amount increases a little bit by cost of living. Now, one interesting thing, the Tax Cuts and Jobs Act of 2017, right, when President Trump was in and they passed this through the legislature and they made a bunch of changes to the tax code, they doubled the exemption amount. So it was, in 2017, it was $5,490,000. And then they essentially doubled it to $11,180,000. And then it's increased a little bit to the point that we're at now in 2022. This is set to expire at the end of 2025, as are all the changes that Trump put into effect in that law. So in 2026, it will revert back to the $5,490,000 plus any adjustments for inflation, the cost of living adjustment that they make on it annually. Okay, so it's likely going to come back down. The tax legislation that has been proposed over the last year or so has also talked about knocking this down quite a bit. So this is always up for change. There's highly debated in the political sphere about how much should we tax and is that right or not? And there's obviously two opposing sides on that, but that is the way it is currently. All right. Now, a couple things that this doesn't include. Number one, this doesn't include leaving assets to a spouse. If you were to pass away and you leave money to a spouse, then there is no estate tax on that. You can leave any amount of money to your spouse and it does not go against the exemption amount. But that doesn't apply to children. If you leave it to children or anybody else or grandchildren, then this is going to kick in. Now, this exemption amount is combined. This is per person. Okay, so if you're married, then essentially the exemption amount can be doubled even more. So if it's $11,180,000 for one person, you add two spouses and it's $22,360,000. Okay, so it's quite large, and probably the vast majority of people are never going to have to deal with this and never have to think about it. Okay, so a spouse can also use any unused portion of the estate tax. Let's say you die and you leave some money to kids and other things, and then you pass on other money to your spouse, but you don't quite reach your exemption amount, right? Maybe you pass on $5 million, but you still have, $6 million plus in exemption. That unused portion of the exemption can move on to your spouse. And when your spouse passes away, then they can add that to theirs, right? So 11 million plus your 6, so 17 million, okay? Or whatever the tax is at the time. So that's how that works. Very friendly between spouses. It gets complicated depending on, there are other factors that complicate this, okay? It's not as easy as spouse, but we'll leave it there at the simplest terms for now. Now, tax rates, so above that exemption amount, if you pass on any money above that, that's where taxes kick in. And they vary from 18 to 40% on the federal level. Let's say I die and I pass on, I don't have a spouse, okay, and I'm just passing on money. So my exemption amount is 11,180,000, or actually right now, right, it's 12,060,000, excuse me. So in 2022, I die, it's $12,060,000. For every dollar above that, I'm going to be taxed. And basically, it ranges, right? There's a lot of little tax rates in there, tax brackets for this tax. But anything from $1 to $1 million, I'm going to be taxed somewhere between 18 and 39%. So it goes up every couple, every $10,000 or every couple $100,000, it moves up. So it ranges all the way up to there. Anything $1 million, $1 million and $1, okay, starting then and above. So basically anything above $1 million is taxed at 40%. So if I come out and I leave $25 million behind, then I get 12 million that's exempted. I'm going to pay between 18 and 39% on the next million, okay, up to like 13 million. And then between 13 and 25, I'm going to charge 40% on that. So that's how that works. Some states also have their own estate tax, okay? So there are a number of states that say, hey, yeah, and we have our own amount. And once you leave $2 million, then, we're going to start taxing it on the state level and so forth. So you just check your state and things like that, okay? So that's how the estate tax works. So there's a lot of strategies to circumvent this and get around it. One important thing to note is life insurance, as we talked about in a previous module. Life insurance is tax-free, right? The death benefit's tax-free. But the total amount of life insurance that beneficiaries receive is actually included in this calculation. It's part of the gross estate. So if you have a $20 million insurance policy, should be a lot, but you could. If you have a $20 million insurance policy, even though the benefit is technically tax-free, you don't pay income tax on it, that 20 million is going to be added into the gross estate, and anything above the exemption is going to be taxed based on the estate tax, not income tax, estate tax. So that's important to know because some people don't realize that, okay? It could still be taxed. The other things that go into the gross is just the gross estate, or just all of your assets, all current fair market value of any assets that you own, real estate, stocks, business interests, homes, on and on and on. All right, so that's the estate tax. And we'll talk more about that in the tax side. I just want to give you a primer and thought maybe most of you would find this kind of interesting. And some of you could be at this point where this matters, and so you can plan for it. All right? Okay, that wraps up this video. See you guys in the next one.
Just something to be aware of as you plan long term.